If you thought 2022 was an interesting year, 2023 is about to get wild. I'm going to show you the charts that you need to know that bring us through 2022 and then our expectations for next year. It's important to follow along with these details because that's going to make you a better investor. That's going to make you understand what's happening with your retirement account, and you definitely want to pay attention. First thing, we're going to look at the charts. We're going to explain it in depth. The second part is really showing us how we got to this point and where we'll go on from here. I'm going to bring you all that information. You don't want to miss it. Let's begin. So let's introduce the situation right here. After $18 trillion rout, global stocks face more hurdles in 2023. Recession, rate hikes, risks spurring earnings slowdown in 2023. This is the big one that investors are watching right here, because if we get those earnings to come down, that means stock prices falling, that means more layoffs, that means recession, all of these things converging right now in this very year. Question marks remain over how big tech and China will fare. These are the big things because, number one, big tech looks like they hired way too many people. They grew too fast. The stocks went crazy, and now it's coming back down to earth. PE ratios were quite excessive as well. You look at what happens with China. They were cracking down left, right, and center on many different companies. Jack Ma disappeared. He apparently is painting or something in Japan. Lots of different things occurring that were very different from the prior years. So when we look at all of it together, it really presents us with the image that 2023 is going to be a very unusual year, maybe with a lot more volatility. No central banks riding to the rescue if things go wrong all in this time, right? Reeling from a record $18 trillion wipeout, global stocks must surmount all these hurdles and more if they are able to escape a second straight year in the red. Think about this. You look at the MSCI All Country World Index. So you bring all stocks around the world together, down 20% in 2022, and that's the worst performance since 2008. So when we talk about a crisis going on in the markets, this is it. We've got to look at it on a global level. India, by the way, just a little anecdote, outperformed the All Country World Index. So that was interesting to say the least. So you look at it here, where interest rates are rising, and that can show us that when we are in these times of higher interest rates, it really has an impact on the markets as a whole. This just shows you global bonds and stocks see the biggest ever loss in market value. Crazy, right? We just lived right through that. We just went through it. Yes, we survived. You don't have to worry. You have to plan. You don't have to be concerned. You just have to take appropriate action. All this nonsense, fearmonger, and all this silliness that I keep reading about, we just have to know what's true. And what do? Well, of course, we've got to be prepared. Stocks fall to end Wall Street's worst year since 2008. S&P 500 finishes down nearly 20%. You could see the charts. One of the most aggressive Fed tightening cycles ever. Now that's coming from zero. So I think that's also important to note. They keep highlighting this. But in that respect as well, coming from zero to basically anything seems really tight. But this is what we have. Comparing the prior cycles that they've done. I love, for some reason, I find it extremely interesting to look at the history of the cycles and the historical elements here. Don't ask why, but anyway. Treasury yield curve inversion, currently predicting US recession time and time again. You look at the yield curve. What's a yield curve, GPS? Well, if you could see this on many different levels. Let me just explain it really quickly. I've done this many times before. Basically, if you're taking out, you're buying a bond and that bond is 30 years, or you're going to buy one that's 3 months, you would expect that it would give you a better yield on the 30-year than it would on the 3 months. But what if that was completely flipped? That would be odd, right? Well, that's what's happening today. The shorter term debt is actually getting you more yield than the longer term debt. So this is called the yield curve inversion, and that generally, on almost every single case, generally signals a recession. Okay? This is what we have when you look at one of the worst years ever for a 60-40 portfolio. Why is that significant? Is because you've heard time and time again, if you have a 60-40 portfolio, you are diversified. You would have 60% stocks, you would have 40% bonds, And the bonds help to continuously bring in cash flow. And then the stocks are there for growth. And so you can grow over time, but you can also be sure that even when markets are down, you're getting paid. That didn't happen. 2022 was a year that you just got beaten up. Mortgage rates shot up faster than ever, along with, of course, interest rates. So you look at the mortgage rates, 30-year, that's the blue line. They've come off the peak, but they are still quite high compared to where they were before. I mean, it was just free money before. Crazy. In, I believe, UK as well as Canada, the lowest I saw them, HSBC, had a 0.99% mortgage. 1%. Actually, Denmark, how could I forget Denmark? They were given, it was variable, and for just a brief moment in time, they were having a negative interest rate mortgage. I mean, it's just wild. They're paying you to take on a mortgage. Crazy. Inflation trajectory, reminiscent of the 1970s. So you could see the patterns of before. If you might be hard on that font there, but those big spikes sort of in the middle, that's the 70s. And we saw that, and I'd love to talk about that more in depth, but obviously there are many different things that occurred to bring us into these parts of the cycle. US dollar reverse course on Fed adjustment. The Fed downshift in pace of rate hikes has weakened the greenback. And I believe I have another chart on this. What does this all mean though? Like, why am I showing you this charts? It's not just to look into history and say, oh, whatever. We need to understand that 2023 is a year in which you're going to have some difficulty. So you have to maintain, number one, you have to maintain a balance where your actual investments are. You can't say, no, I'm 100% in Tesla stock because I know that's going to go up. Well, if you don't have that much invested, you can take that risk, I guess, or you don't have any dependents, you don't have family members that you got to worry about. But if you want to be more prudent, you have to have your money spread out a little bit at least. You need to be smart about this. And I could talk about that more in depth if you'd like, but you got to be wise right now. A lot of people are simply hoarding cash because the landscape is very difficult. So there's always cash. There's always real assets, because real assets will maintain value over long periods of time. Sometimes certain stocks never come back to where they were before. Look at this, S&P 500 past growth scares and bear markets, just showing us prior year and then the next 12 months return. Usually after these big downfalls, then you get that recovery period where whatever it was either resolved or papered over. And you could see that certainly it has that impact. So many people are simply waiting for the Federal Reserve to pivot or to begin printing money. Nominal annual return on US bonds, terrible time frame for bonds. Hadn't seen anything like this before. Just look at that. And it's been a big change. In fact, I am wondering what people are implying they will do over the next little while, because I think they're a little bit confused. That's for sure. You look at particular stocks, I got some examples. Amazon lost half of its value this year as tech stocks got crushed and recession fears grew. Now, this is important as well because you see one of these stocks that, no, it can't happen to Amazon. It's too big, it's too important. Yes, but the stock doesn't necessarily correlate. Tesla stock fell 65% in 2022. The last few trading days of the year, it started to move up. We'll see if that trend continues early on in 2023. It was its biggest ever annual decline. Well, remember, it followed, a couple years there of extreme gains. Meta, also previously known as, or I should say the artist formerly known as Facebook. Look at it over the last year, just got really beaten up for many different reasons, and they're pouring billions into the metaverse. And I know you and I want to hang out in the metaverse so that we can not really walk around, but float around, because there's no legs in the metaverse, and buy NFTs. I'm not even sure what that's all about, but here we are. And then this article is basically just saying, if you're waiting for a housing market crash or a correction in prices that will make your dream home more affordable, the data shows you are not alone. Single-family home sales fell for the 10th straight month in November to less than 4 million, down 3.5% from the same time last year. You look at it, why? Because people see that the interest rates are too high, borrowing costs are too high, and as a result, we could find some cheaper alternatives if we simply wait. And that's key, okay? That is deflation. While we're seeing an inflation in many cases, we're actually looking at it from deflationary environments, whether that's stocks, whether that's bonds, whether that's even in the case here of real estate. Watch it very closely to see for yourself and what happens. Buying the dip in tech is backfiring. Wait a minute. Buying the dip could backfire? My favorite degenerate YouTuber had said that I should buy the dip. Well, it didn't work in 2022. Average prices paid for stocks by individual investors in 2022. You can look at the black, that's average price paid, and the latest price is red. And Tesla, Apple, AMD, Nvidia, all the fan favorites did not perform well. That's just the way it goes. And what's really important about that? What is the key message? If you get anything from this video, the key message is you have to watch what the Fed does. People want to deny that. They tried buying the dip and they got burned. Fed flips, totally different story. Okay, this is the dollar. Actually, the dollar started changing as soon as the market chart started to change as well. So around October into November, early November, it was sort of around that peak, and then it had come down minus 8.5% in a span of about 2 months or so. And that's key because you look at the difference between the stock market and the US dollar, and they have this sort of opposite effect with each other. This just gives you different examples of the stocks that had performed well and poorly. You could see that they talk about it in here, but essentially just looking at the different sectors, okay? If you're interested, I know some people are, but I just wanted to make it very clear that when you do encounter these crises, whether it's an energy crisis or a financial crisis, it's going to have a different impact on each sector. And some get the benefit from it, like energy stocks. What else did really well? Shipping companies. Okay, that's another one. Semiconductors got, initially it was, oh, what are we going to do? What are we going to do? Then they started performing well because they had gotten battered down. And then they started performing poorly again. It all depends on the sentiment during this period of time and what the expectation would be over the longer term. If the stock market drops, this has a negative impact on retirement accounts, particularly 401ks, because these often include investments in stocks. When the stock market declines, the value of these investments may also decline, which can reduce the overall balance of the 401k account. This can be concerning for people who are planning to retire soon and rely on their 401k as a source of income, as a lower balance may not be able to provide the same level of financial support. The stock market crash of 2008 is a good example of the potential negative impact of a stock market decline on retirement accounts. During this time, the stock market saw a major drop in value, leading to losses for many investors. This had a ripple effect on retirement accounts as people saw their 401k balances decline significantly. This made it more difficult for some people to retire and forced some to continue working longer than they had planned. It's important to note that while the stock market can be volatile in the short term, the index itself has historically trended upward over the long term. The trouble is relying on this as a source of income, since we never know how long it will take to return to its previous value. And that's really key. A lot of people simply rely on it, and there's no way, absolutely no way, that we know the future. We have to balance it, we have to be prudent, we have to be wise, and we cannot be stuck in our ways. I hope that this information will help you invest, will help you manage your retirement account in 2023. If it was, simply hit that subscribe button down below, and I will bring you a video every single day in 2023, giving you the news you need to know before it gets out there in the mainstream. You gotta subscribe, it's right next to the like button, and I'll see you tomorrow.